Good morning, I'm Benjamin Sullivan, and welcome to Market Monday for March 16th, 2026. 2 weeks ago, a gallon of regular gas cost under $3. Today, the national average is $3.58. That is a 60% jump in just 14 days. You have noticed, your neighbors have noticed. This week, we break down why it happened, what it means for your money, and why staying the course still makes sense. The price spike traces back to one event. On February 28th, the US and Israel launched strikes against Iran. The operation is called Epic Fury. 2 weeks in, the Strait of Hormuz is effectively closed. And that strait carries roughly 20% of the world's oil supply. Iran's new supreme leader declared this week that it will stay closed. Oil surged past $100 a barrel on Thursday, and that's the highest price since 2022 when Russia invaded Ukraine. The response from the global community was historic. 32 countries agreed to release 400 million barrels of oil from emergency reserves. The US is contributing 172 million barrels from the Strategic Petroleum Reserve. The market's reaction? Well, prices barely flinched. That tells us the market is pricing oil higher for longer in contrast to the headlines. Now let us shift to what this means closer to home. The S&P 500 closed Thursday at 6,672. This is the lowest level since November. All three major stock indices posted 3 straight days of losses. Energy and utilities were the only sectors in the green. Travel, industrials, technology took the brunt of the selling. On Friday morning, the Fed's preferred inflation gauge came in. Core PCE printed at 3.1% year over year. Now this is still well above the Fed's 2% target. The key detail? That data is from January. The initial effects on the oil shock won't show up in data for another 2 months. Analysts expect March inflation to come in meaningfully higher as energy costs work through the system. This week, the Fed meets for the first time since January. They are almost certain to hold rates steady at 3.5 to 3.75%. They'll also produce updated economic projections. What we know now is that growth is in fact slowing. Fourth quarter GDP was cut in half from 1.4% to 0.7%. Further, the Atlanta Fed's GDP tracker dropped to 2.1% this week. That's an estimate of second quarter GDP. Inflation is still sticky, and this keeps the Fed in a difficult spot. Here's what matters. Oil shocks are not new. We saw them in 1973, in 1990, and in 2022. Each time, prices spiked, headlines turned dire, and the investors who stayed disciplined came out ahead. We know the Strait of Hormuz will reopen. The question is when, not if. Military operations, diplomatic channels, and reserve releases are all underway. The disruption is real, but it is temporary. This is not time to react to headlines. This is the time to lean on the plan we built together. To those of you watching this, chances are you know someone who does not have a plan to lean on. Maybe it is an adult child watching the news wondering what this might mean for their 401k. Maybe it's a friend or a colleague who does not have someone to call when the headlines get loud. We're here for those conversations. Share this video or send them our way. It takes only 15 minutes to get started. That's all we have for you today. As always, thank you for watching this week's edition of Market Monday. Join us again next Monday for more of the insights that matter to your money.